Hello everyone, Chapter 17, Working Capital Management. This is final chapter of the class and we will see daily financing planning. One of the most critical matters in daily financial management is how cash is paid and received. The firm tends to hold a certain level of cash and there are several reasons. Firms may want to take advantage of unexpected opportunities. Many firms want to hold cash for emergency. They also have cash for paying bills. They can get higher returns if they use cash to invest long-term in assets. So there's always trade-off of holding cash, opportunity cost holding cash versus transaction cost of converting marketable securities to cash when cash is needed. In the United States, we usually use checks to receive and pay cash. So there must be some time gap between cash balance recorded in the cash account in firm financial statements and cash balance in bank accounts. This is called float. There are two different types of floats. Disbursement floats are generated when a firm writes a check. Book balance should be declined when checks are written, but bank balance will be declined when checks are cleared. So disbursement balance is bank balance minus book balance, and it should be positive. Another type of float is occurred when checks are received. When checks are received, book balance will increase, but bank balance will increase when checks are completely cleared. So collection float, bank balance minus book balance should be negative. Some of these two floats are called net float. Managers usually concerned if their firms have negative net float. And the value balance is also very important. The maximum net float the firm needs to speed collection to maximize net float, the firm needs to speed collections and slow disbursement. There are three factors that may determine net float: mailing time, processing delay, and availability delay. To speed collections, decrease one or more, and to slow disbursements, increase one or more. If there's too much delay, then systematic overdrafting is possible, called kiting. The firm may write a check for no economic reason other than exploit float. To avoid it, the regulator tries to build the system to decrease delay. Now banks use electronic image to clear check 21 system. So floats may be substantially decreases. Example, you have $3,000 in your checking account. You just deposit $2,000 and you wrote a check for $2,500. What is disbursement float? Disbursement float occurs when we write a check. Our book balance decreased by $2,500. In checking account, we have $3,000 balance until the check is cleared. So disbursement float is 3,000 minus 500 equals to 2,500. What is collection float? Collection float occurs when we receive a check. Our book balance increased by 2,000, but checking balance is 3,000. So the collection float is 3,000 minus 5,000 equals to negative $2,000. The net float is 2,500 plus negative 2,000 equals to 500. The book balance is 3,000 minus 2,500 plus 2,000 $2,500. Finally, what is your available balance before clearing these checks? It is still $3,000. Now, how to collect cash? The easiest way is to collect cash at the point of sale, over the counter collection. And yet, it is not common. There may be pre-authorized payment system which fix payment amount and dates in advance and will be automatically paid. We can use mailing checks too. The problem is we want to make this collection system more efficient. We can use several locations to collect checks. Customers mail checks to designated PO boxes. Using several locations may be more effective since we can reduce mailing time. Then local banks pick these checks up several times each day. The lockbox is maintained by bank, and the bank will automatically deposit checks to the firm's accounts. The issue here is since we have many lockboxes to reduce mailing time, we will have multiple bank accounts. So cash should be concentrated to firm's main accounts, called cash concentration. It reduces mail and processing time. These figures show how lockboxes and cash concentration work. How about disbursement? As we discussed, disbursement float is beneficial for the firm. To increase it, the firm may mail check to distant bank or post office. However, it may not be ethical or even optimal. To control for disbursement, the firm uses zero balance accounts. Instead of having safety stocks for each sub-account, the firm holds safety balance in only master accounts and have several zero accounts. Bank automatically transfer funds from main account to sub-account as checks presented for payment. That way, the firm do not need to hold too much cash. If there's idle cash, we should invest, usually to money market securities, financial instrument with original maturity less than 1 year. If the temporary surplus is originated by seasonal or cyclical activity, the company may buy marketable securities with seasonal surpluses and convert back to cash when deficits occur. If expenditures are planned, the firm can accumulate marketable securities in anticipation of upcoming expenses. The figure shows compromise short-term financing policy. The blue part is short-term loans, and the green part is held by marketable securities. When we decide which short-term securities we will invest, several factors should be considered. Firms often limit the maturity of short-term investment to 90 days to avoid loss of principal due to changing interest rate. We should not invest in marketable securities with significant default risk. Marketability, easiness of converting to cash is also important, and we should consider different tax characteristics. First part quiz. You have $5,000 in your checking account. You just deposited $1,000 and wrote a check for $3,500. What is the net float? To get net float, we need to compute disbursement and collection float. Disbursement float is bank balance 5,000 minus book balance 1,500, which is 5,000 minus 3,500, the amount of check we wrote. So $3,500 is disbursement float. And collection float is 5,000 minus 6,000, which adds 1,000, the amount of check we deposit, negative 1,000. So net float equals to 3,500 minus 1,000 equals to $2,000. This is the end of the first part. See you in the second part.